Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are you're watching this video because you got an email from me by being on my email list. If you're not on the list, click the link associated with this video to get on it because you're going to want to get the next video I do. This is Stock Trading 101, a series of educational videos I'm doing to help anyone who's just starting out in the markets. And we're starting out with the very basics in video 2 right here. And that is, how does the stock market work? What makes a stock go up and down? That might sound like a silly thing to talk about, but it may actually be one of the most important concepts to understand. Because if you have no idea what makes the stock market go up and down, then it's going to be very difficult to be a successful trader or a successful investor. And it's very easy to actually get caught up in some ideas that can be detrimental to your success in the markets if you don't understand the simple basics of what's influencing stock prices. To just give you one example of this, there's a tendency among a lot of people to think that there's some group in control of the market, that they are making the market go up and down and do what they want. And therefore, you get tricked or trapped by these people's activities, these manipulation people in the markets. And one thing about that is that there are lots of people trading the market every single day with all sorts of motives, even people that aren't human, computer robot trading programs. And all of these different people and programs have different objectives and time frames. There could be someone that sells a mutual fund just because they need the money to go pay some bills, or someone who has gotten a windfall and is putting that into the market as an investment or automatically deducting from a check. So there's various motives behind market movements that trickle down into various stocks. So it's not all can be explained as manipulators are controlling the market or anyone is controlling the market. That's really not what's happening. But if you believe that, if you come to think that everything is going on because of these people controlling the market, then it becomes almost impossible to become a successful investor or trader, because what it does, it sets you up to have a victim mentality. The idea then becomes that, look, I'm this little person and these giant manipulators are doing all these things, and they're the reason why I'm having difficulty in the market. They're making me make mistakes and so forth. When you're giving way too much power to think that anyone is able to control the situation like that in that manner. But more importantly, you're putting yourself in a position where it becomes difficult to advance and learn and become more successful in trading and investing, because to do so requires a bare minimum belief that you have the ability to learn and think for yourself and take information and process information and learn how to do it better and move forward. But if you maintain a victim mentality, it then becomes impossible to do that. And people with that, and a lot of people get trapped like that. What they end up doing is jumping from one market to another. They'll buy one thing, losing that, blame sinister forces, jump to something completely different, lose there, and just repeat this pattern over and over again, being stuck in a trap. And it's because of this victim mentality that they hold, which it makes it hard to get them actually motivated to do the things required to be successful, such as just watch a video like this and start to learn, or read a book like my book, Strategic Stock Trading, or take courses. Just you study, do the work and research to find good stocks to buy, good trades to make. So push that all out of the side and look at what really is the most important thing in making the stock market or individual stocks actually move, because that's the thing you want to understand, and then how to interact and play with that as you go forward. So what is that? What is it that makes the stock market work? Well, I'm going to go very quickly to a page out of my book, even though this book is well over 10 years old now. The concepts are timeless. I didn't make up the concepts. They've been around from other books for, well, some of them for hundreds of years, but that's because markets are markets, and that's what they are, you know, and the nature of markets has never really changed that much. And that's why the concepts are timeless, and the way they function is timeless. So I'm going to flip to one simple page in the book. Actually, I took a screenshot of the book and the page, so I'm going to go to that so you can see it. And okay, this is page 15. Learn to read stock price movements. And we got three basic movement patterns here. There really isn't another one. This is it. This is the three things that happen in a stock or a market. This is almost everything else in this course, in the future videos of this course, are going to be derivatives of this one simple concept, that there's three basic price patterns, price trends to any stock, to any market, whether that's a stock market, a bond market, a gold market, a silver market, an oil market. Three basic patterns, and everything else is is deriving off that one fact. That's it. And it doesn't matter who or what is creating the pattern necessarily. If it's, you know, so get the idea. If you still want to believe that the markets are controlled by someone, doesn't matter, because their activities are coming out in one of these three patterns. So these three patterns are very simple: an uptrend, a downtrend, or a sideways trend. An uptrend happens when a price makes consistently higher highs and higher lows, higher highs and higher lows. So it makes one high, it may dip a little, then it breaks that high, dip a little, breaks that previous high. And it does this. A downtrend is the opposite. A stock makes a new low, has a weak bounce, a new low, a weak bounce, a new low. That's a vicious downtrend. Sideways, though, is different. Sideways is when it is what it is. It's what it says. Sideways, you know, you're not making major new highs or major new lows. You're in a range, and things can be stuck in a range for quite some time. In fact, when it comes to the stock market itself, the averages, the Dow, the S&P, they actually spend more time in a range than they do having the thrusts up or the falls. In fact, the declines, the downtrends typically are faster than the uptrends, and then the sideways trends last even longer than the uptrends. So market can go sideways for 10, 12 months, then boom, an uptrend for 6 months, which generates, that's where most of the gains are actually generated. And downtrends can happen fast. In fact, stock market crashes typically only take place over 6-8 weeks. You know, the serious crash, which, you know, they are kind of rare, but one happened in March, April of 2020, one happened in 2008. But that 2000 bear market was really a bear market that lasted for several years. We'll talk about those bigger cycles in a future video. However, this concept, uptrend, downtrend, sideways trend, everything is a derivative of that, as you'll see. Anything you do in the market is a play off that. Even if you're a long-term investor, you're betting that there's an uptrend that's going to last for a long time. And that's one important thing. You have to understand what when you are looking at the market or a stock is what's your time frame? Because you can do 1 minute charts, 5 minute charts, 30-minute charts, daily charts, weekly charts, monthly charts, yearly charts. How long are you planning on holding something when you buy it? Because that's going to determine a lot of your success, the difficulty in what you're doing, and the types of charts and indicators that you actually are using in the market yourself. But as a general rule of thumb, the shorter the time frame, the more difficult it actually is to make money, because you're not only playing for smaller gains, but you're more. It's the action can become more and more random. The shorter the time frame, the more random the action. The longer the time frame, the easier it actually is to make money if you use good money management. Another topic for later, but the patterns are more reliable. So this is a thing to remember and to consider and keep in mind. Now, I still haven't answered the question though. What makes the stock market work? What's making these patterns even happen? And the reality is, it's simple. Free market forces of supply and demand. It's basic economics. If you take economics 101, that's the concept they're going to be teaching you almost the entire semester. If you go to college and take economics 101, the whole course will be a derivative of that concept of supply and demand. Just as successfully trading or investing in the markets is a derivative of this concept of the trend, uptrend, downtrend, or sideways, identifying that and aligning yourself with that, with the proper strategy to use. It's all that simple. So free market forces, okay, let's explain that a little bit more. That's a buzzword people use. So what does that really mean? Supply and demand. And that's driven by psychology of the traders and investors in the market. So when prices go up and down or go sideways, what you end up having are psychological support and resistance levels. Support are levels in which a stock or the market typically tends to bounce off repeatedly. It'll fall to it and bounce, fall to it and bounce. So it becomes it's typically a good buy point. Resistance is the opposite. It's where something tends to top out repeatedly over and over again. Eventually, you can get to the sideways trend. This is when these two forces are roughly equal. That's why you're locked in sideways price action. So as an example, let's say there's a stock called Horseshoe, and Horseshoe is trading in a range between $5 and $10. And it's stuck in there for months. Every time it goes to 10, it comes back down, hits 5, bounces back up, heads back up to 10. Sideways trend. What's really going on is that you have a solid resistance at 10, solid support at 5, and this means that the forces of supply and demand are roughly equal. Now, where does supply come in from a stock? Supply comes in from the shareholders, people who could potentially sell the stock because they hold it, and they're a force that's keeping the stock from going above 10. Well, who are they? Well, they could be some of them are people that bought the stock 5 years ago, and maybe they bought it at 20 and they saw it fall to 10, and it's been locked in this 10-5 range, and they like, oh, every time it goes up to 10 because I got a loss, I got to get out. So they're out there. And then you might have people who think, well, the business isn't so great, I will just want to get out of this company because I don't like the stock and I just want to get out. So they're in there. And then there's other people that say, well, every time this thing goes to 5, it tends to bounce, so I'm going to buy it there. And they're part of the support. Another part of the support are people that say, look, this is a good company, and I think when it goes to 5, that it's cheap based on earnings, based on the sales, based on the assets. So every time it goes to 5, I'm a Warren Buffett type investor. I buy. I'm investing. I don't care if it goes to 10 and comes back down. I don't care. I'm investing because that's the type of guy I am. So there's different mentalities that can be at work. Notice that there's not like one group in control. It's different people, different outlooks, different reasons, but all of them combine together to create market forces of supply and demand. And when they're roughly equal, boom, you're locked in a sideways trend. But at some point, that supply of overhang of sellers in the stock, they may end up vanishing because they're depleted. So how does that happen? Well, perhaps there's people that start to think, well, this company's prospects are going to get better in 6 months, or hey, there's a new product they're going to come out with, so I think the earnings are going to go up. I'm going to buy this stock, and more people start to think that. They get into the stock. Some more buyers start to come in, and they start to, the demand for the stock starts to increase, and they overtake the supply, and that's how you create an uptrend. And the downtrend obviously is the opposite. Those dip buyers, the Warren Buffett types and so forth, they end up running out of money to buy the stock because so many people keep piling in to sell. And at some point, the sideways trend is broken and a new downtrend begins. And when that happens, it's usually because there's a coming deterioration in the earnings, in the sales of the company. It could be company specific. It could be because of the sector the company's in, or it could be because of the overall economy. So when you are having a recession, when economists and people on the ground floor of these companies start to see weakening economic or company-specific conditions coming down the pike, they will start to sell ahead of that reality. People tend to price in events before they even hit the headlines in the stock market. So that's how insiders really do have a big influence, more so than people just randomly buying off of message boards, off of top lists on the Robinhood app, and so forth. It's people that got the real information because they're insiders. That doesn't necessarily mean they're on the board of directors or something. They can be just simply close to an industry. Imagine a comic book store owner or a comic book fan that goes in the store every single day, knows a lot more than I do about the comic book industry, and is going to be better at analyzing what's going on in that world than me. I don't know nothing about it, but there's all sorts of niches and sub niches like that in the economy and the stock market, and they create sectors of the market that are go up and down with the stocks in the sector tend to move together. So anyway, if you got questions, this is a lot. It's a huge concept. If you got questions on it, leave a comment below or email me. Subscribe to the email list too to get notified when the next video is up. And if you're just watching this on YouTube, also click the subscribe bell, click subscribe, and then that bell button, because then YouTube will notify you, because I also do videos about the actual stock market action. This is just a special series, Stock Trading 101. So all that said, good talking with you, and stay tuned for another video very soon.